the United States is grappling with a significant crisis in commercial real estate as the office market faces unprecedented challenges and vacancy rates soar to alarming heights. Remote work remains prevalent, and companies are cautiously implementing strategies for employees to return to the office. These factors have resulted in vacancy rates spiking to a staggering 20.7% nationally in the second quarter of 2025, a figure that suggests more than just a temporary decline. It's indicative of a structural shift within this multi-trillion-dollar industry. This oversupply of vacant office space is initiating a tough awakening for property owners and lenders, jeopardizing property valuations and exerting stress on the balance sheets of regional banks that have extended commercial loans. Nationwide dilemma of empty space. The issue of office vacancies affects virtually every urban center and suburban market across the nation. While the national averages paint a grim overall picture, certain technology-driven cities reveal an even bleaker reality. Take San Francisco, for example, where the office vacancy rate has skyrocketed to a staggering 27.7%, up from just 8.6% prior to the pandemic in 2019. Other prominent business hubs are not far behind, with downtown New York experiencing a vacancy rate approaching 23%, while Charlotte mirrors this figure at 23%. Surprisingly, even suburban office parks, once perceived as potential beneficiaries of a shift towards decentralization, are now witnessing record-high broad economic impact. The overflow of empty office space is triggering a series of financial repercussions that extend far beyond individual building owners. Landlords find themselves squeezed between declining rental incomes and the increased cost of servicing their mounting debts, a precarious situation compounded by an approaching debt deadline. Approximately $290 billion in loans connected to office properties are set to mature by the end of 2027, placing immense pressure on the industry as refinancing becomes increasingly difficult and defaults on these loans become more common. This financial strain influences regional banks, which are heavily invested in commercial real estate lending. Moreover, the ongoing crisis is having a critical impact on municipal revenues. As property values decline, so too does the tax base that cities depend on to fund vital public services, including education, transportation, and safety. An urban policy expert pointed out that this creates a negative feedback loop where potential cuts to services can render cities less appealing, thereby further diminishing demand for available office spaces. A shift in industry focus from offices to other uses. In light of these extraordinary challenges, the commercial real estate sector is experiencing a notable strategic pivot away from traditional office developments towards more resilient asset classes. This shift manifests in two significant trends. First, the complicated task of repurposing obsolete office buildings into new, functional uses, and second, a broader capital reallocation towards sectors exhibiting stronger demand fundamentals. Developers are now being compelled to rethink how urban commercial spaces are utilized, ultimately recognizing that the speculative office construction model of the pre-pandemic era is no longer viable. This responsive strategy aligns with profound shifts in both work environments and formats across the United States, which seem likely to be enduring. The challenges of conversion. A key response to the surplus of empty offices is the increasing trend of adaptive reuse, specifically transforming vacant office high-rises into residential apartments. Currently, over 149 million square feet of office space across the country is earmarked for potential conversion as developers and municipal officials tackle both the office vacancy and housing shortage crises simultaneously. For instance, in Philadelphia, an innovative approach to removing over 1 million square feet of outdated office space for residential use has succeeded in stabilizing Center City's vacancy rate at around 20.4%. However, these projects often confront formidable barriers that hinder broader implementation, such as zoning challenges. Many urban areas establish zoning regulations that prevent residential conversions without a lengthy and often costly approval process. Structural incompatibilities. Office buildings typically feature deep floor plates, complicating the design of apartments that require ample natural light and ventilation. Utilities overhaul. Integrating residential plumbing, electrical, and HVAC systems into existing commercial infrastructures is both complex and expensive. Economic viability. The substantial costs associated with conversions can risk making the resulting residential units unaffordable for many prospective tenants. A shift towards more resilient sectors. Additionally, developers and investors are steering their focus away from the beleaguered office market. High construction costs, coupled with uncertain demand, have prompted many to shy away from new office developments altogether. Instead, there is a marked shift in investment towards asset classes benefiting from stronger demand characteristics. Foremost among these are logistics hubs and modern industrial facilities, supported by pre-engineered solutions from firms like Worldwide Steel Buildings, which facilitate rapid construction to satisfy the ongoing growth of e-commerce and the need for robust supply chains. The dichotomy between market performances is striking. While the office sector grapples with declining health, the industrial market remains relatively stable, evidenced by its rising vacancy rate of 7.1%. which still reflects a healthy appetite for well-located modern facilities. In summary, the U.S. office market is not simply undergoing a short-term downturn. It is experiencing a profound transformation led by the post-pandemic changes in work culture. The era of speculative office tower construction that characterized urban skylines for decades appears to be fading away, increasingly replaced by searches for flexible, mixed-use, and economically viable development patterns. The future of commercial real estate will likely hinge on its adaptability to a world where the conventional office is just one of many venues where productivity occurs, marking a significant shift away from pre-2020 paradigms.